We have the big Fed meeting coming up this week, the decision tomorrow. Not a lot of action expected, but a lot of anticipation for Jay Powell's commentary. What are you expecting, and how do you see what he says on tomorrow, I should say, impacting what happens in March?
Yeah, that's a great question. I think there's two key things to focus on tomorrow. The first is whether the Fed drops a hiking bias in its statement. We do think that is likely. The second thing to focus on is how Chair Powell fields questions during the press conference around the potential for a rate cut as soon as March. Our own expectation is that the Fed won't cut in March. We think that growth is good enough for the Fed to wait to gain more confidence in the disinflation trend. We do think a rate cut in May is plausible. However, if disinflation stays on track, on that front, it's worth keeping in mind that a measure Fed officials have recently been quoting, the 6-month annualized pace of core PCE inflation. That's been below 2% for 2 months now. If that trend continues, we do think that the Fed will pivot to easing.
Okay, I know you're also looking at another central bank decision, the Bank of England also making its decision coming up this week. What's your outlook on the Bank of England, and why are you so bullish on gilts right now? You're overweight on UK bonds.
Yeah, I think one of the reasons that we think, first of all, in terms of our expectations, we think the Bank of England will also be pivoting to easing. And the big picture comment for investors to keep in mind is that policy rates are going to end the year lower this year. That's a difference for the last 2 years. And so that creates an opportunity in core fixed income bonds. And we think that the Bank of England will deliver more easing than the market is pricing, hence our preference to be overweight there. Like the Fed, we think the Bank of England will drop its hiking bias this week, but we think that they will wait until May to kickstart that hiking cycle. But once they get going, we expect 6 rate cuts in the UK versus 5 in the US this year.
Okay. So I know fixed income is definitely your wheelhouse, but I do want to get your take on earnings season. Give us a sense of what you've seen so far, and also bond yields declining as we head into this Fed meeting.
Yeah, first of all, I think the decline in bond yields that we saw yesterday, that reflected a positive response to the US Treasury funding announcement, and so less new supply than anticipated. And that similar positive response was seen back in November. So that's one of the reasons for that. As it relates to earnings, we get a lot this week, but there's 2 key takeaways that we've gleaned so far. The first is that lower input costs means that companies are no longer raising prices to expand profit margins. They're going to have to rely on innovation and increasing sales. That reinforces disinflation at a macro level. And then one of the second early observations, it's tentative, so bears monitoring, is that we're seeing some moderation in spending on services like travel and entertainment. Now, this could be cold weather, it could just be a normalization in demand, it could be a symptom of the loud budgeting trends that we're seeing on social media. But big picture, we're still seeing companies generate cash flow, we're still constructive of their ability to service their debts.